Okay, this video is talking about the second half of Module 22 about the financial system. And so the financial system is basically this system where we're working to transfer savers' money to borrowers. Sometimes this happens where, for example, you know somebody that is going to be able to lend you money. So this is going to be, for example, when you get a loan from a friend. You're going out to eat and you don't have enough money, so they're going to loan you money, right? But sometimes what happens is that sometimes we don't always know let's say, rich enough people to be able to get the loan that we need to be able to cover all the costs that we incur. So for example, if we're talking about, I want to buy a house and I want a $250,000 loan, I don't know about you, but I don't know anybody that has just $250,000 sitting around in cash that's willing to loan it to me. So the financial system is basically going to transfer some of that money that savers are just kind of building up into people that are borrowing it and needing it. So this could be people that individuals, but it could also be businesses. Now, within this system, there are some challenges. So one of the challenges within the system is transaction costs. Transaction costs are basically the cost of making a deal. This is not only just interest rate that you get charged, but also the time and effort that goes into trying to negotiate this deal. Transaction costs can be different depending upon the asset. So the asset type, it can be different. For example, if we're talking about the differences between, for example, stocks and mutual funds or bonds, I found this particular kind of a chart from, I think it's E-Trade, looking at the transaction costs, for example, of doing stock trades. So standard transaction costs, according to this, is $9.99, right? Whereas, for example, a bond is going to be $1. Okay, it's going to be a lot cheaper. So there's going to be some transaction and costs involved in each asset. So it just depends. One of the other challenges within the system is risk. Risk is this idea that you may not know what's going to happen in the future. You may not know if you're going to be able to get your investment back. Every financial asset has a different risk involved with it. The risk could be related to, what's going on with that particular investment. And so, for example, if we're talking about stocks as a whole, as a broad category, stocks are generally a high-risk investment. Now, yes, there are some safer stocks, but it is going to be basically you're hoping that the stock, the value of that particular company is going to go up over time. So here's the thing, though, is stocks are fairly high risk, but things like, for example, CDs, which are called certificates of deposit, basically that's a loan to a bank. That's basically what a CD is. CDs are fairly low risk because, number one, banks don't go out of business very often. They do, but they don't go out of business very often. So chances are by the time my CD comes due, the bank's still going to be around. They're going to be able to pay me off. But if the bank does go bankrupt, we do have fail-safes in our country where, for example, we have the FDIC, the Federal Deposit Insurance Corporation. And the FDIC will insure your money up to $250,000. That includes money in your savings account, your checking account, as well as any money in CDs. So as a result, CDs are very low risk because they're basically insured by the government. So, like I said, is that the risk varies depending upon the asset type, but the risk is also associated with the return. Because if you think about it, if it's a very high risky investment where, geez, I may not get my money, how are they going to get people to actually invest in it? Well, the way they're going to get them to invest in it is they're going to have to pay more. They're going to have to pay a higher return on it to be able to make it worth people's while. So a higher potential risk, higher potential return, but lower risk, lower potential return. Diversification is also one way to be able to spread out risk. Diversification basically boils down to that whole saying, don't put all your eggs in one basket. So This is the idea of, you have your money in a lot of different things, so not just stocks, but, maybe some CDs, some bonds, some mutual funds. So that way, if, for example, one thing drops like a rock and one thing fails, you're not going to lose all of your money. So you have it spread out with a theory that not all the baskets will drop at once. Okay. The last challenge with this system is liquidity. And liquidity is this idea of how easily can I turn my investment into cash without losing a whole lot of interest, losing a lot of value. So liquidity is, how easily can I turn it into cash? So liquidity is different for different things. So for example, if we're talking about a stock, okay, yes, I can sell my stock pretty quickly, pretty easily, and turn it into cash. However, if we're talking about bonds, okay, bonds are going to have maturity dates, meaning that there's a specific life of the bond, how long the bond lasts. In that case, if you want to cash in a bond early, if it's, for example, a 5-year bond, you are supposed to wait 5 years before you can get all of your money. However, you could potentially either sell it to somebody else or cash it in early in some instances, but you will lose a loss of interest. So that's kind of having to do with the liquidity of a bond. All right. In class, I also have you looking at the differences between individual financial assets and financial intermediaries. We did a chart comparing these. Please make sure that you get this from Canvas if you don't already have it, and add that to your notebook. All right, let me know if you have any questions.